The Federal Reserve's favorite inflation gauge just dropped, and what it shows could shape interest rate decisions for months to come. The measure is called the Personal Consumption Expenditures Price Index, or PCE. It is not as widely known as the Consumer Price Index, but it is the number Fed officials actually rely on when they decide whether to raise rates, hold them steady, or start cutting. The reason the Fed prefers it is straightforward. The PCE tracks a broader range of what Americans spend money on, and it adjusts more smoothly when people shift their buying habits. That makes it a more flexible, and in the Fed's view, more accurate read on where prices are headed. The Fed's target is 2% inflation. When PCE comes in above that level, it signals that price pressures are still running hot, and that the central bank may need to keep borrowing costs elevated to cool things down. When the number comes in softer, it opens the door to rate cuts, or at least a pause in any further tightening. That context matters because the Fed has spent the better part of 2 years in a difficult position. Inflation proved far more stubborn than officials expected. The central bank responded with one of the fastest series of rate increases in decades. Then it shifted into a waiting mode, holding rates steady while watching the data for a clear signal that inflation was genuinely moving back toward that 2% goal. Markets paid close attention to each PCE release for exactly that reason. Bond yields tend to move in line with the surprise. If inflation comes in hotter than forecast, yields often rise, reflecting the expectation that rates will stay higher for longer. If the print is cooler than expected, yields can fall. Stocks are more complicated. They can swing in either direction, depending on whether investors are more focused on what the data means for growth or what it means for interest rates. A single report rarely rewrites the Fed's entire outlook. Policymakers tend to look for patterns. A string of readings pointing in the same direction carries far more weight than any one data point. But each new release either reinforces or chips away at the current consensus. And right now, the consensus is fragile enough that the margin matters. The Fed's next policy meeting gives officials a formal moment to weigh this reading alongside jobs data and broader economic figures. What the PCE shows will either add pressure to move or give the Fed more reason to stay put. Watch the direction of the surprise relative to expectations. That gap, more than the headline number itself, is what tends to move markets in the hours after the release. This briefing is brought to you by First Financial News, clear daily coverage of the economy and markets at firstfinancialnews.com.